Welcome back to DASAR. On DASAR podcast today, I have a fantastic guest with me, Raj Sheth. I've known him for a few months. He's a serial entrepreneur in the SaaS space and has a very unique point of view about how to acquire SaaS companies and then scale them up to a few $1 million ARR. And so that's what we're going to talk about today. Raj, thanks a lot for joining all the way from San Francisco. I'm very excited about this podcast.
Thanks for having me, Darshan. I'm excited too.
Perfect. So first things first, what is Decalab and how do you go about acquiring SaaS companies? At what stage? What's the process like? And maybe some examples that you can share with us?
Absolutely. So I'll give a super quick intro on why we picked this model and then what the model is. But exactly 10 years ago is when my first SaaS product journey started, RecruiterBox, and I'm sure we'll talk about that later. But that happened to be a bootstrap journey. So we bootstrapped it to a few million in revenue, ran the company for almost 7 years, and then we were acquired by a private equity fund in San Francisco. And obviously we learned a lot and made a ton of mistakes there, but we didn't go the institutional capital route. And frankly, that was not by choice. So I don't want to claim that we had this, very deliberate vision. We kind of fell into a lot of things. And then it just seemed, like most SaaS products with teams in India, it was just making more and more revenue. So we kept unlocking those growth bottlenecks. And then when we couldn't, or when we were trying to attempt other products, is when we felt the exhaustion, and this offer was very welcome. So basically, after this experience, and before RecruiterBox, I had 2 failed B2C companies, and I'll tell you why that's relevant to the psyche of Decalab. The venture scale model, as as all of us know, as you know very well, is 1 in 10 or 1 in 100 does the true venture scale growth. A lot of people raise a lot of money and a lot of rounds, but if you look at the revenue trajectory of venture scale companies, that's 5% or less. And it's a very inspirational mindset, but the mindset is go big or go home. We are going to dominate a category, we are going to invent a category, so on and so forth. I had the go big or go home mindset in my 20s, but essentially after all these years, like 16 years of doing this, etc., my mindset was, of course I want to go big, we all want to go big, but I no longer want to go home. So what's the better model for me? The go home is not an option at all, right? And that's the foundation of Decalab, basically, which is that we want to get to 100 million in ARR through 10 product companies, right? And instead of deploying venture scale capital on an idea and getting it to product market fit, we are actually trying to buy revenue, right? So the exact model is like, I will go to the end point and we can work backwards, is that if I wanted to solve for getting to 100 million in revenue across 10 products, just oversimplifying it, 10 products of 10 million each, we want to buy 1/3 of the revenue. And then obviously we love growing these. So that's the big difference between us and PE. There's no arm's length execution. We are into every line of code and every landing page and every growth strategy, because we are operators, and that's what we want to do. We want to perfect the 1 to 10. We love the 1 to 10. And so we want to grow that 1/3 of revenue, but super efficiently. So the other 1/3 will come by organic revenue growth. So take a $3 million ARR company, we grow it to 6 million ARR across, let's say 4 or 5 years. And then the profit of these companies will be so great that the holding company Decalab uses the profits to acquire more revenue. So long rant, I'll pause there, but that's the rough model of Decalab. And we bought 1 company already last year without raising any capital. That was a smaller one, a starter acquisition. And now we have learned about what should we buy, what should we not buy, what companies will have characteristics to kind of do this journey somewhat to 10 or at least to 6, and so on and so forth. So that's what I'm trying to do.
Awesome. And this is what I want to now talk about, which is FlyData, which was the first company that you acquired. Maybe we first go into details of what was the ARR? How much did you acquire it for? How did you finance that acquisition? And when you say you are operator who helps grow this through various channels, how is it that you do? Like, what is your skill set? What is
Sure,
your capability that you're
sure,
bringing to the table?
absolutely. So we'll just start at the top. Basically, FlyData, now the model that we have embarked on, FlyData was slightly smaller because we wanted to get our feet wet, to be honest. And we are like, hey, if we screw this whole thing up, we want to make sure
It
like
doesn't
we know
wipe
how
you
to.
out.
Yeah, exactly. So FlyData only had 500,000 in ARR, but what attracted me to it is it had almost no churn. And those of us in SaaS, when you say almost no churn, I'm sure people are going to double back when they listen to it, that what is he talking about? Aisa kuch hota hi nahi. Like these things are not possible. I was fixated on it because I was being hit by so much churn in the extreme SMB in RecruiterBox for 7 years. So I understood the pitfall of that pretty well. And sometimes it's very hard to, you know, kind of get ahead of that churn or like do something about it. So anyway, 500,000 in ARR. And I literally had a rudimentary equation on Crunchbase saying, hey, all the companies that raised money in San Francisco 4 years ago or earlier never raised again, team size or 10 or small, right? And we did this whole search to see like what seem to be companies that are not doing that whole venture scale journey. Otherwise, you won't have 8 people in San Francisco if you raise some money after so many years, etc. Of course, we were trying to find revenue information, and I sent out this outbound campaign. I usually I put it out. I even put out my campaigns, and in fact, we did a masterclass at Upeka also, where I sort of shared this. So anyway, I got a lot of response from the cold emails. Found FlyData off a cold email to the founder. He had been at it for a long time, had this very loyal customer base doing this specific infra product. Like, as we know, about 10 odd years ago, the world moved to cloud data warehouses, right? So you have your MySQL Postgre, and then everybody was saying big data, big data. Funnily, now everything is big data. So you don't hear that word too much, big data, because all data is big. So nobody wants to query their 500 million row MySQL DB, so they use Amazon Redshift or Snowflake, and this was a product that helped you sync all your DBs in real time to Redshift. Long story short, I sort of, it was just him. The investors had obviously written it off. They had raised $9 million maybe 6 or 7 years ago or so, and the investors had obviously written it off. So I kind of made a super low offer. I don't remember what it was because I was obviously not confident of it. And then where it ended up basically is I made a 390K cash, and with closing or something, like we ended up paying about 400K for that business and in cash. And then we also paid the founder up to 10% of revenue or $5,000 a month, whatever was greater, for the next 2 years. That's how it was set up. That was the exact deal. The way we financed this first deal is an amazing founder, serial entrepreneur, an advisor of ours, also in Austin, Texas, came on board as the first sort of seed angel investor, right? So that's how we financed it, because we knew we would do more of these, but this was a trial one, and then we would figure it out, like what the structure needs to be, etc. So that's how we financed it. And then your big question is, what is your skill set? What do you guys do? So I'll take this in two parts, right? Why I'm excited about our team is, a lot of people are doing this. There are a lot of these words out there right now: SaaS roll up, venture studio. And so what is abundant obviously is capital, meaning a lot of people, like I'm seeing people here, of course, super smart people. They know how to make great money, great returns, but they're from real estate, for example, and then they're trying to buy like a SaaS asset, and maybe they think they'll hire people. What we have, and or some people are great growth folks, but they are not engineers, so they're hoping that whatever they buy will come with engineering continuity. The reason why we were able to get FlyData at such a steal is it was not a saleable company. because nobody that wrote the code was there anymore. So actually, it's like buying a time bomb. So any engineer will understand this. Like you can't even push a change to production. We took it on anyway, and that's because we were getting a deal. Some of the original engineers from RecruiterBox are part of Decalab, of course, and we have Gautam Seshadri, who's the co-founder and CDO, and I have 2-3 other founding engineers. So our engineering, just to give you a quick sense, we rewrote the whole product because we wanted more integrations. We knew we went into it with eyes open. Usually a terrible idea to do an acquisition of that kind, but we knew we were getting a steal, we are getting a deal, we'll have to rewrite it. We think it's going to take 5 months, it might take 10 months. We were used to that. So that's one part of the equation, that we have a very strong engineering product team. And by the way, rollout is out now and people are paying for it, and the team is elated. Because keep in mind, this doing workflow SaaS and RecruiterBox is very different from doing suddenly database replication. We didn't know anything about it, right? So we don't want to pretend like, oh, we have a thesis on the space. We have none. Like we didn't know anything about it. But engineering is great. And on the growth side, we were fortunate enough to get super deep lessons because RecruiterBox being a self-serve product, we got a lot of inbound lessons. So we worked on SEO, content, paid ads, PPC, all of which we are doing in FlyData right now. As an example, if you, of course, after this podcast, after this call, if you type in MySQL to Redshift in Google, see what is the first organic result. And we are born yesterday in this. We just made FlyData's new website. We bought it. 6 weeks later, new website was out. And so these SEO things that I do, like we write these long technical posts, we'll run it through a tool like ClearScope, and it will sort of, it's super cool for SEO, by the way. Any SaaS founders or growth people listening in, and we put it in the editor and it gives you a score, and I was getting a B++, and then what's amazing, it tells you all the things to change in the article till it gets to A+++. If you post that on your blog, that will go to the right on the top 3 in organic Google. So if you check MySQL to Redshift or Postgre to Redshift, for both of those, FlyData is on the top, you'll see, right? So these are small things. And of course, it's obviously not all that rosy because those words also don't have a lot of search volume. That's the other side of it. So you experiment with PPC, same thing. You experiment with educational content. You're doing outbound sales, which is, what we do as well. Like as a co-company, we do that even to, buy more companies or get in touch with founders. So that's some of it. Like this, actually this second, your third question itself is a loaded one. Like that is a whole session in itself. We feel like we can obviously get, we may not have run a $200 million P&L, but that's exactly the point. We can get a company from, $500,000, $1 million, or $3 million to $6-7 million. Like the composition, I don't think of the revenue changes too much. It's just like, I love seeing these companies or products where, what happens is, which is great, one bootstrap, founder running it super profitably, and something worked, so they never tried the other channels of customer acquisition, or they put out a product for $99 and kept improving the product. And we were also stupid enough to do this at RecruiterBox and never changed the pricing. So just kept giving away a very powerful product for $99. So these are the levers we are hoping to move, right? When we buy these companies.
Superb. This is so powerful. And I love this conversation for 2 reasons. One is you're coming at it from an operator model rather than an investor model, right?
We don't know, sorry to interrupt, but we don't, actually that's where we are bad at. We don't think like investors or finance guys. So we have to watch out for that, funnily, actually. But yeah.
So in that, as a follow-up to what you've said, you've got FlyData. It looks like it's moving towards success. It's giving you enough cash flow, which would enable the next round of acquisition. But if you have to get into the next acquisition, there's another 6, maybe 9, maybe 12 months of work that needs to go in while you have FlyData running through, right? Which is the same team. And so we all just have 24 hours, 7 days, 365 days. Any thoughts on what's your approach to tackle that as you grow?
Absolutely. So we are going to get some native teams from this acquisitions. So FlyData came with two support people, two support engineers. They're still with us, of course. The other acquisitions are going to be slightly larger, of course, both in revenue and in some inherent team. I'll give you an example. One company that I'm looking at has about 14 people. We intend on keeping 7, 8 of them. There will be engineering continuity. So these companies will have their own teams, and then there'll be a Decalab SWAT team layer on top, right? So that this is exactly what we're trying to figure out, and we've also figured out that we want to do only 3 more, and then run them for 3 more years, and then we will be ready to do 7 more and run them for 4 more years. So in 7 years we want to be at 10. So we are not like these tiny capital or a private equity fund. What I feel awesome about a year in is we are being very specific. And so one thing is, a lot of people are giving advice. You could do this, you could do this, you could do this, but you're exactly right. The bane is in what you said, like what will we enjoy doing? What's our core competency? What will be the capacities? So of course we are going to put more SaaS operators into the Decalab model. I'm hoping to get a couple of founders to a couple of people, by the way, have committed, are on the bench, and they are phenomenal, like much better growth people than me. Like, a couple of these people, like I'm not even 1/10 of them when it comes to growth. But that is super exciting because the SWAT team layer will do the and what we've also realized funnily is there is about, you said 9 to 12 months. Actually, it is 24 months, meaning we will have to do 24 months of heavy lifting before we are like, okay, this monthly revenue growth rate is acceptable. Month to month MRR growth rate is acceptable. So that's how we're thinking about it. So, two things: the individual companies will not get wiped off. So it's not like we're just buying product and it's just the Decalab team, which is great because some of these people are phenomenal, right? Like I'm very excited about the inherent teams at these companies, right? Like what mostly is going to change, what's definitely is going to change is they're being sold because the founders want to leave. So the leadership change will be there, but a lot of the other people, want to be there. And the way we look at it is great product. There are 4 engineers there. They are in the US. That's fine. We are messing with that. But the lead flow is flatlining, and then there are 3 people in the marketing team. So where's the ROI there, right? So we obviously go deeper into it. So that part of the team may not continue. So that's how we're looking at it.
What are the top 3 lessons that you got from RecruiterBox?
The biggest 3 lessons: one is the well-rounded team. My 2 B2C companies, and won't go into that, but 2 B2C companies failed. I was doing them as a solo founder. And RecruiterBox, my 2 co-founders, Raghu and Girish, they had actually thought of this idea, build this product. They had built another product before that also. They were, at it for 2 years. They both went to IIT Chennai. So my number 1 lesson is, if you have a well-rounded team, you can do anything. So I think the founding team or the early team or the right team members is without like doubt or without thinking, is the number 1 lesson from RecruiterBox. The number 2 lesson is, don't fall in love with your own ideas. This is at least my personal lesson. So I rely a lot on, now I have tuned and trained my ears to rely a lot on listening to what the customers are saying. In fact, if I can change that point to a little bit, don't fall in love with your own ideas, I would say, don't write a single line of code before you talk to customers. I think you can literally, people are like, oh, I have to show them something, then I'll make a sale. Now I make a sale in a conversation. We haven't even written a single line of code. And so you have to validate this. There are a lot of frameworks out there for people people often get confused by it. Some people go too deep in it. And who's it? Shreyas, the ex-head of product at Stripe, is a very famous product leader. I love the way if you look at his Twitter threads, he breaks
Yeah.
down how we use, even while using the biggest amazing frameworks and jobs to be done in Mom Test and surveys, we still manage to have confirmation bias and confuse ourselves, and how it goes from product to engineering, and then everything's done 18 months later and nobody's paying for the product, right? Number two lesson: talk to your customers. Make it, there are enough frameworks out there, and this is a whole other session, or we can talk offline if anybody wants to. But I'm talking to customers, putting things on Slack channels, not asking leading questions. This was the biggest number two lesson, right? Because, and this spills over into everything. People are like, oh, I'm a product person, let me listen to this. No, this is everything. This is company, your marketing, your positioning, your language, your sales, your ICP, who you're going after. Everything is derived from it. You're solving a problem for a set of human beings, which you call a market. Don't add your own drama to it, right? So this is number two. And number three, incidentally, is my personal lesson. Number three is get good at the capital game. People have put such like cart before the horse, before the wheel, before the manure, if they are good at the capital game. Like if they're good at the capital game, they manage to, bring the world together and get a team together and get a product together. So that's a personal learning curve for me. Because, by the way, you
Can you
initially also
elaborate?
said,
Can you elaborate on that?
some people are great at raising money and raising big money, and some of us are not. And but because sometimes we don't know how to say the right things in the right order, right? Like blue ocean and land grab and category creation, and like VCs all turned on. I guess I don't know. I don't know that tribe at all. I don't understand that tribe, and I want to. I want to. I don't say this in a defined way because I don't get. I kind of see it's funny. Like I talked to a couple of 100 founders that are now take advice from it. There's always a 20% delta, I feel, in all our skills to actually get that done. Like even the most worshipped founders, I think they're 20% smarter than some of us, but they're able to raise 500% more money. So
It's extremely
so that,
skewed as well. Yeah, extremely
yeah.
concentrated, right? And I think just in India, we've seen about $12 billion being invested in venture capital in just this year, in 8 months.
Yeah.
So that's it. Now
Yeah.
I want to talk a little on the macro, on the trends that you may be seeing, because you're also looking at acquiring SaaS companies, right? Now SaaS, since COVID has happened, SaaS has come under the spotlight. It's very sexy. The valuations are good. And SaaS Bhumi just released a report which says, it's going to be this bigger market. Even in India, even the Indian customers are going to pay for SaaS. It's no longer build in India, sell to the you can build in India and sell to India. I have my limitations on that or concerns on that.
Yeah.
But leaving that aside, what are you seeing in terms of when you're looking at acquiring SaaS companies? Where are
Yeah.
founders plateauing, and why are they plateauing?
The more, I think what I'll start with, the most important thing to realize, because I see this firsthand from, at least from my lens, is not everybody is trying to build a venture scale company. So in SaaS founders. So this is a direct answer to where do they plateau, right? And see, there are two, three very tangible scientific points of company building or revenue building. And we all know that. See, first there is even getting $1 from a customer, right? Then there is getting product market fit. So like whatever that is, 500,000, 1 million, $2 million, right? And then there is getting scale, growth stage. So if you look at a lot of people that just have products, I would actually say they have products and businesses. They don't have companies. Companies an engine of people that is designed to do the growth stage activity. And of course, it all comes together hopefully in execution while you're going through the first two stages, right? And great founders and great entrepreneurs go through all three stages if you think about it, right? Like the creation, validation first, the product market fit, and then the growth stage. A lot of the founders have product market fit ish in some degree, but they're going to hit a local maximum because either it's not big enough market, they're not positioned it right, they're not going to do certain things that require for it to be a four scale company, etc. So why I'm mentioning that is where founders plateau is there's a long tail of SaaS both in India and the US and other places, the long tail of SaaS in that category as well, and they still look like $1 to $3 million businesses. And in the 1 to 3 million bucket, it's interesting. You have both. You have companies doing a lot of things right. They just don't have the market. They might be going up to something that's not a market, or they don't have the right pricing model or whatever. And then you have people who have just two guys sitting around, and maybe they are just on not paying attention, and they go on the Goa beach, and they are also at 3 million. So there is a mixed bag. Otherwise, where founders are plateauing, I wouldn't know about that, because again, like there are all sorts of us. Like everybody has different skills. Like we plateaued in a lot of different places, but I think if you now, for example, there's SaaS Bhumi, there is Growth X by SaaS Bhumi, there is Upekha and Prasanna, and this all is so wonderful. This wasn't there 10 years ago. So now the kind of SaaS founders I'm seeing are way smarter than people like me 10 years ago. Like we were clueless, we were just like trying to, we were like, great, people are paying for our product and they're paying monthly, and we just stumbled into a lot of things. And now there are programs saying, hey, did you do ICP, ideal customer profile, are you doing this way, and all the things are known, and it's just wonderful. So the information arbitrage plateau won't happen, to be very specific. And now it's about, if the companies, what is their appetite and ambition, and do they understand that they can unlock bottlenecks at 1 million through this, unlock bottlenecks at 3 million through this, unlock bottleneck, because what will happen is everybody gets to a million in a different way, right? And that's usually a great cowboy story, and things that don't scale and all, what YC and Paul Graham say. But inevitably what happens, that to go from 1 to 10, you have to get into the company building, you have to get into the repeatable, predictable processes, you have to get into your channels of customer acquisition, you have to get into like delivering and not losing products because your product's not moving. The SaaS product never done, right? Like it will keep living and breathing. And especially if we're trying to go up market, do the founders have that propensity? Because sometimes they will solve a problem, but they will only see value from it if they're selling to the mid market, for example. I won't even say enterprise, right? But then they might leave the product in a certain way. So sorry, long answer to your question, but I hope some of that helps. I can happy to double back on that thing about the India market and all you said, but let me know.
This is great. So we're kind of at the end of the podcast as well. So before we go, you're acquiring SaaS companies, which means you need great people to join you.
Yes.
So if
Yes.
someone's looking to enter into the SaaS world, or someone's looking to exit their own SaaS startup, how do they reach out to you? What are the kind of people you're looking at? Maybe you can just give a quick shout out to them.
Yeah, that I appreciate that, by the way. The easiest way is Raj at decalab.io. It's not Decalabs, there's no S. So it's DECALAB.io, not .com, Raj at decalab.io. You can find me on LinkedIn. Just do Raj Sheth, FlyData, RecruiterBox, etc. And we are looking for, excuse me, everybody. So on priority is growth folks, right? Design folks, and then engineering, right? And and this will be a constant stream. So even if people want to participate, especially, growth leaders are looking to be CEOs of a SaaS company as well. Like that, I would highlight that because, we do intend on having 5 or 10 of them CEO of FlyData, but eventually I will not do those jobs well. So I think hopefully wherever there can be a, founder product fit or a founder market fit to some of these things we're doing, we would love to have you in here, and especially the companies that are looking for a all cash liquid exit. If you are between $1 million and $3 million in revenue, or even like 750K to 3 million revenue, growing at least 20% year over year. 20% is not a lot, but that's minimum 20%, because one of the big lessons we learned is we don't want to buy a declining graph company. Nobody can do anything to those, but we'll look at some temporary flatlining, but 20% year over year, 750K to 3 million. Please reach out to me as well. So to buy these companies, by the way, and this would be a certain kind of an investor, we are also looking to raise money to buy the next 3 companies, by the way, because our model's proven out a little bit. We will never put that money into the running of these companies, but this is the corpus fund to buy these companies. So for any investors that think this is their cup of tea, if they want to hedge all their moonshot, 1 in 100 bets with something that is a sure shot. Also, when it looks like a value play, but it will have growth play kind of returns. So basically, what we're building is a Berkshire Hathaway of SaaS.
So Raj, thanks a lot. This has been awesome. Hopefully, we can get you back on this podcast along with some of your teammates, the acquisition companies, so that we can have, both the sides of the table and have a nice conversation around it.
Yeah, I would love
this
that.
has been awesome. And again, wholeheartedly appreciate your time and your ability to just share whatever you've learned and your experiences. Thanks a lot.
Thank you. Thanks for having me. Thanks for listening.